You've checked your credit score 17 times this month, watched it bounce between 640 and 655, and felt your stomach drop each time it dipped, convinced you've destroyed your financial future without knowing what you did wrong. Your friend casually mentioned their 780 score, and you have no idea what they're doing differently. Here's the truth nobody tells you. You're obsessing over things that don't matter, while the factors that actually control that number are simpler and more actionable than you've been led to believe. The paralysis is costing you real money. Should you close that old credit card you never use? Or will it tank your score? Does checking your credit hurt it? Should you carry a balance to prove you're responsible, even though it means paying interest? You've read conflicting advice, gotten vague answers from bank representatives, and heard confident myths from friends who are completely wrong. So you freeze, doing nothing, while that mediocre score costs you money every single month in higher interest rates and missed opportunities. Your credit score isn't mysterious. It's calculated using exactly 5 factors, each weighted by a specific percentage. Once you understand what these factors actually measure, you'll stop wasting energy on myths and start building credit strategically. More importantly, you'll realize that improving your credit isn't about perfection. It's about consistent habits that compound over time. Before we break down the 5 factors, understand why this matters beyond just having a good number. Someone with a 620 credit score buying a $300,000 house pays approximately 7.5% interest, roughly $2,300 monthly. That same person with a 760 score pays about 6.5% interest, roughly $1,900 monthly. That's $400 every month, $4,800 annually, and over 30 years, that's $140,000 in extra interest. That's not a house payment. That's a second house you just paid for in wasted interest because of a credit score difference. Payment history accounts for 35% of your score, and it measures one thing. Do you pay every bill on time, every time? Every credit card, loan, and mortgage payment gets reported to credit bureaus tracking whether you paid on or before the due date. Meet Jennifer, a 32-year-old marketing manager earning $68,000 who couldn't understand her 620 score when she thought she paid everything on time. She pulled her credit report and discovered something shocking. 3 years earlier, she moved apartments and forgot to cancel her internet service. The company sent a $60 final bill to her old address that she never saw. After 90 days, they sent it to collections. That single $60 oversight dropped her score 83 points and would stay on her report for 7 years. Jennifer spent 3 years wondering why she couldn't get approved for decent credit cards, and the culprit was a bill she didn't even know existed. Payment history is unforgiving but responds to positive behavior faster than you'd think. Late payments hurt less as they age, so a 3-year-old late payment damages your score much less than one from 3 months ago. If you start paying everything on time today and maintain that for 6 months, you'll watch your score climb steadily. One habit protects this entire 35% while you sleep. Set up automatic payments for minimum amounts on every credit account. This doesn't mean only pay minimums. It means you create a safety net, so even if life gets chaotic, you never miss a payment. That automation is like having a financial bodyguard protecting more than a third of your score without requiring willpower. Credit utilization accounts for 30% of your score, and this is where I see the most confusion and biggest opportunity for fast improvement. Utilization measures how much of your available credit you're actually using. If you have a $5,000 credit limit and your balance is $1,000 when the statement closes, your utilization is 20%. Lenders see someone using 20% as responsible. Someone using 80% looks potentially overextended, even if they eventually pay it off. Here's what most advice gets wrong, and this is crucial. Everyone talks about keeping utilization below 30% like it's magic. And while that's better than being above 30, it's incomplete. The real sweet spot that maximizes your score sits between 1 and 10% utilization. But here's the twist. 0% utilization, meaning you never use your cards, actually helps less than showing small consistent usage that you pay off. Credit bureaus want to see you can handle credit responsibly, which requires actually using it, not just having it sit unused. This is where the most damaging myth lives, and it's cost people millions in wasted interest. You do not need to carry a balance and pay interest to build credit. Your credit card reports your balance once monthly when your statement closes. If you charge expenses throughout the month, Let the statement close with a balance showing. Then pay it in full before the due date. You've built credit without paying any interest. The bureaus see responsible credit use, and you pay nothing because you paid before the due date. Carrying a balance and paying interest does nothing extra for your score. Nothing. It just makes you poorer while credit card companies get richer. Let me show you how powerful understanding utilization can be. Marcus, a 28-year-old software developer earning $75,000, had a 680 score and couldn't figure out why it wasn't higher since he never missed payments. He had 3 cards with $15,000 combined limit and was carrying $9,000 in balances. His utilization was 60%, crushing his score. Marcus got a $4,000 bonus and faced a choice: invest it, save it, or pay down debt. He paid down the cards, dropping his balance to $5,000 and his utilization to 33%. The next month, when lower balances were reported, his score jumped 42 points to 722. Same person, same income, same payment history, just lower utilization, and suddenly he qualified for better cards with rewards. If you're wondering whether you should stop using cards entirely to keep utilization at zero, let me address that now. Using cards for small regular expenses like gas or groceries, letting the statement close with that small balance, then paying it completely before the due date is optimal. You're showing active, responsible use while keeping utilization in that ideal 1 to 10% range. If your utilization is currently high, paying down balances is the fastest way to improve your score because utilization updates monthly when creditors report your balance. If this breakdown is cutting through confusion you felt for months, do me a favor. Hit that like button so YouTube shares this with more people who need clarity instead of myths. Drop a comment telling me which credit myth you believed before watching or what still confuses you, because your input shapes what I create next. If someone you know is stuck in credit confusion or paying higher interest than they should, share this with them right now. And if you want more finance concepts explained this clearly, hit subscribe so you don't miss the next breakdown. All right, let's keep going. Length of credit history accounts for 15% of your score, and this is where closing old cards becomes critically important. Credit bureaus want to see you've managed credit responsibly for a long time. They calculate average age of all your accounts, and the older that average, the better for your score. Closing your oldest card, even if you never use it, removes your longest history from the equation, lowering your average account age instantly. Here's the strategic approach that protects this 15% with minimal effort. Keep your oldest cards open and active, even if you barely use them. Put one small recurring charge on each old card, maybe a streaming service or phone bill. Set up autopay, then put the card away. That card is now working for you passively, aging like fine wine, increasing your average account age every month while requiring zero effort. If an old card has an annual fee you don't use, call and ask if they'll convert it to a no-fee version. Many will, letting you keep the account age without the cost. Meet Diana, a 52-year-old professional re-entering the workforce after divorce. She had been an authorized user on her ex-husband's cards, but never had credit in her own name. After divorce, she found herself with virtually no credit history despite being financially responsible her entire adult life. At 52, she felt behind and worried it was too late. Diana opened a secured card requiring a $200 deposit, used it for small purchases, and paid it off monthly. And after 6 months, her score climbed from 580 to 660. After a year, she qualified for a regular card and kept both open. Now at 54, her average account age is 2 years, her score is 715, and she's proving credit building is possible at any life stage. The fourth and fifth factors are credit mix at 10% and new credit at 10%. I'm grouping these because they combine for only 20% total, meaning you can relax about these and focus on the big three: payment history, utilization, and history length. Credit mix means having different credit types like cards, auto loans, and mortgages. Lenders like seeing you manage various types responsibly. But hear this clearly: never take out a loan purely to improve credit mix. The small boost isn't worth paying interest on debt you don't need. Let credit mix happen naturally. New credit measures how many times you've applied recently, because opening multiple accounts quickly looks risky. Each application generates a hard inquiry, and too many bunched together can lower your score a few points each. But here's the relief you need. Checking your own score through free monitoring services creates a soft inquiry with absolutely zero impact. You can check daily if you want, and it won't hurt at all. The myth that checking damages your score has prevented millions from monitoring their credit, which is like trying to lose weight while being afraid to step on a scale. When shopping for mortgages or auto loans, bureaus understand you'll compare rates, so they count all inquiries for the same loan type within 14 to 45 days as one inquiry. This means you can aggressively shop for the best rate without tanking your score, as long as you compress shopping into a focused period. Let me directly address the myths nagging at you. Myth 1. You need to carry a balance and pay interest to build credit. Completely false. Pay your statement balance in full monthly. You build identical credit history whether you pay interest or not. This myth has generated billions in unnecessary interest for credit card companies while providing zero consumer benefit. Myth 2. Closing cards improves your score by showing you're not relying on credit. Actually, the opposite happens. Closing cards reduces total available credit, increasing utilization percentage if you carry any balance. It also removes credit history, lowering average account age. Both hurt your score. Only close cards if they have high annual fees you're not using, and you have many other cards, so losing one won't dramatically impact utilization or average age. Myth 3. Making more money improves your credit score. Income is not part of credit score calculation at all. A teacher earning $45,000 can have an 800 score, while a surgeon earning $400,000 can have a 600 score. Credit scores measure how you manage debt, not how much you earn. This is empowering because credit building is available to everyone regardless of income. When you started this video, credit scores probably felt mysterious and designed to stress you out. But now you understand it's a formula with 5 factors: payment history at 35%, utilization at 30%, credit history length at 15%, credit mix at 10%, and new credit at 10%. The first 2 control 65% of your score, and both are completely within your control through simple, consistent habits. Pay everything on time by automating minimums. Keep balances low relative to limits. Maintain old accounts to build history passively. Here's what I want you to remember above everything. Your credit score isn't a judgment of your worth, and it's not a permanent sentence. It's a snapshot of current credit behavior that updates monthly based on what you do today. Bad credit can become good credit through nothing more complicated than understanding these 5 factors and acting consistently. The person at 580 today can absolutely reach 720 within 18 months if they know what to focus on. You've just taken a real step toward financial clarity by investing these minutes to understand what determines your credit score, and that matters more than you realize. Every person who understands these concepts becomes more empowered to build the life they want rather than accepting whatever their limitations allow. That's what this channel is about. Creating a community where financial knowledge isn't gatekept by experts using complicated jargon, but shared openly by people who genuinely want to see others succeed. If that mission resonates with you, hit subscribe and become part of this growing community of people who believe understanding money shouldn't be intimidating. Drop a comment sharing your biggest takeaway or the financial topic that still confuses you most, because your input helps me create better content and helps other viewers realize they're not alone in their questions. When you subscribe, you're not just getting notifications, you're joining thousands of others who refuse to let financial confusion hold them back from the opportunities and security they deserve. Your financial future isn't determined by where your credit score sits today. It's determined by whether you understand what affects that number and whether you're willing to build the simple habits that improve it month after month until you have the score that unlocks better interest rates, more opportunities, and the financial breathing room that comes with lenders competing for your business instead of you begging for approval. I'll see you in the next video where we're breaking down exactly which credit cards beginners should open first and how to use them strategically to build credit while earning rewards.